Well, welcome once again to this edition of New Knowledge here, which is a partnership between the Town of Abingdon's Economic Development Office, the Washington County Chamber of Commerce, and the folks here at Virginia Highlands Small Business Incubator. We're pleased to come to you today with Daniel Bailey, and Daniel is going to present to us on simple financial strategies for business professionals. So Daniel is a native of Washington County. He is the regional vice president of Primerica, and he's been doing that since 2001. He is a graduate of Virginia Tech, so go Hokies. He's got an impressive resume. He has both a BS and a BA. So that is somebody that was in higher ed for a long time. That's very impressive to me. And so he's a smart guy. So he played varsity football for Frank Beamer. He returned to Abingdon after school and married Landry, who is online with us today. She works with him as well as Grayson Waddle. So we're happy to have all of the whole office shut down now to observe this fine presentation by Daniel Bailey today. So take it away, Daniel.
Absolutely. Well, thank you, Mark, for that introduction. I need Mark around all the time to do that introduction, and he'll kind of cover, I guess, my first slide and portion of it at least. But to get started today and tell you all a little bit about us, what we do, and when Mark and Jean approached us with this opportunity to speak, I was really excited about it. We partner and work with a lot of business owners, corporations, small businesses, 100 plus employees, 1,000 plus employees. So we work kind of through that cycle of small businesses, medium sized, large, and then what some people would call, I guess, kind of mega cap in that space. And so today, what I want to do is give you a little bit more just detail about us and what we do, and to give you a little background. I think knowing who's speaking and how did we get to this point, what kind of fueled our idea to be in this field and industry as our career. But as Mark was telling you, I am an Abingdon native. I went to Abingdon High School. I did graduate from Abingdon in 2015, and from there I went on to Virginia Tech, where I played football and had a lot of good memories, but to learn just a lot about work ethic and time management and commitment and integrity and a lot of things along those lines. So a little bit about us. We have been in the small business incubator since I believe it was March or April of 2024. And we were happy to expand into a bigger office in 2025. Something else happened in 2025. Landry and I got married. Landry plays a crucial role in our office. She kind of runs the front desk and does a lot of the paperwork. I call her the glue girl. She holds us all together, of keeping track of everything and making sure all of our clients are in order, and that they're serviced well, and make sure that they know that we care about them. Now, my journey into this industry really started. My dad was actually diagnosed with stage 4 colon cancer back in 2020. And through that process, he had to start planning a lot of things, the estate planning side of wills, trusts, retirements, investments, finances. And I very quickly realized we don't get educated a lot in those areas. And so I was a very analytical person. I started doing research on education-based firms and being able to not only provide advice and investments and plans, but giving our clients and our customers education in that. So today, as I go throughout this presentation, Mark really wanted me to structure it around some key financial concepts, but some strategies that I've just seen work with businesses, things people can miss or just not known about, or maybe even to some misconceptions that we hear about. And so diving into today, I think it's always good to start a presentation with some statistics. And so, statistics I always think about are typically not always the most positive. So, I like to give some statistics that are kind of eye-opening or alarming, and then kind of finish and wrap up with some that are more engaging and positive, I guess you could say. So, in some of my research, I found out that 29% of small businesses fail due to poor cash flow management. And so that means, and I always heard, if Isaiah was on today, I think he was the one that actually told me this, is just because you're a good chef doesn't make you a good restaurant owner. And so cash flow management really kind of boils down to, we're not taught about these things. We can be really good at our craft, but understanding, okay, when that money comes in the front door, well, it's going to go out the back door to things like rent potentially, or a mortgage, or business expenses, things that help us operate in our different businesses. Now, 82% of business failures involve cash flow problems. 82%. So that means 18% of failures don't boil down to cash flow problems. And that could be for other reasons, but that's a large number of businesses. And these are nationwide statistics, not just for our area. But 51% of businesses struggle with uneven cash flow, and 44% of businesses rely on personal savings. Now, in the small business category, I think this fits perfectly, as if our capital and our money coming in the front door for 1 month, or maybe our business is seasonal, we can kind of dive into that personal savings of almost, 50-50, kind of a flip of a coin. So those are all the negative, I guess, statistics. But on the positive side is 30% of small businesses have faster growth rates when they have a plan for their finances. So this can be a little bit different outside of retirement and those sort of things, but with the cash flow coming in, is the certain money allotted for taxes? Is a certain amount of money allotted for expenses, and other marketing or advertising? There's multiple different ways to do that. And then along with that, small businesses that have a plan have a 16% higher survival rate. So when it comes to small businesses, two things that we're worried about is surviving and growing. And so if just a simple plan can be just a small little baby step in the right direction, it gives you a 16% more or higher shot at surviving, but it also gives you a time or a percentage of exponential or accelerated growth inside of that. Because then whenever you're doing your daily flow of business, you kind of have a structure around that. Now, getting out of the statistics category, I want to dive into just some concepts that I think are crucial to all people, whether you're a business owner or not a business owner. But that's very crucial in personal finances. A lot of business can be related to how are our personal finances handled. So I'll go over a 3-account system. I'll cover a concept called the Rule of 72, which I do believe is important when it comes to compound interest, growth of our assets, growth of our money. But it can also come into play whenever it comes to loans and borrowing and those sort of things. Theory of decreasing responsibility. And then the last piece is life insurance. So do I need it? How much do I need, and what type? So going into the first piece is their 3-account system. So I do believe, like I was saying, with personal finances and with business finances, is having an emergency fund available to where if the heat pump goes out or the hot water heater, or if you're a restaurant and your grill goes out, or if you're in the manufacturing side, a machine breaks, so that you're not kind of getting behind on that debt cycle. We're staying ahead of it. So when things like that happens, we can stay out of debt. Because sadly, when I should have pulled a statistic on this, but when an emergency fund happens, typically we're calling a lender or we're swiping a credit card. And so just setting up percentages to where this emergency fund, I typically tell businesses and individuals to keep that amount in a high yield savings account. Or if you have a local bank that you like working with, sometimes they offer really good money markets. Something between right now 2 to 4% is a pretty good rate. So if your money's going to be sitting there for an emergency, let it gain as much interest in as possible. Now, that short-term category can almost get overlooked a lot of times. Most people don't realize, we're prepping for that long term, we're prepping for the short term. That short term savings for your personal life and your business is anything that you could see happening in the next 2 to 15 years. So for a business, that may look like adding some equipment or purchasing a building and kind of growing out of the small business incubator. But in that short term, things that can help us relieve some debt in the future or put us in a better financial standing. This account can help with inflation as well, which I'll talk about a little bit later. And then that long-term savings or investments, that's prepping for the long haul. With business and getting into the business sector rather than more the corporate, is you want to be successful. You work very hard to get your business up and going and staying alive. You can't forget why you started that in the first place. Whether that's retirement or a succession plan, which we'll talk about also later, prepping for the future and making sure that you're achieving your goals as well as the business grows and lives on. So that is the three accounts that I believe that you need and that are important. Now, looking at the rule of 72, I typically sit there and ask, has anybody ever heard the rule of 72? And everybody's muted and cameras off. So majority of the time, most people say no, or if they say, yeah, I think I've heard about it or I learned about it in school, but didn't really write it down or remember it or anything like that. So the rule of 72, it was created by Albert Einstein, and it's the one financial concept or rule that breaks down and explains how compound interest works. So we may think, okay, we have a high yield savings account getting 4%. We're always educated to get the highest percent possible. But when we get that, let's just say 4% CD or money market, where is that going to put us long term? Where is that going to put our business long term? And so I think that's important. Albert Einstein would also tell you this works in reverse whenever it comes to borrowing and debt and those sort of things. So what I'll do is I'll just say we have three categories here. And we'll say Grayson is the 3%. Mark's going to be that middle column, and Gene's going to be the 12%. And so the rule of 72 just states if we divide your interest rate that financial institution gives you or your investments returning, you divide that into 72, it'll give you approximately the number of years it takes for your money to double. So let's just say in this example, Mark, Gene, and Grayson are all 20 years old. And so from 20, so that's 48 years in that far left column. So from 20 to 68, if their parents all gave them $10,000 at age 20, and Grayson says, okay, I'm going to take my money and I'm going to go to Capital One and put it in their high yield savings account. Well, mathematically speaking, by the time he is 68 years old, or in 48 years, that money is going to grow to 40,000. Now, Grayson may have forgot about it or forgot it was there, and he kind of had a surprise and he paid for a car or paid for a new roof on his house at 68. Now, Mark takes it and he doubles that interest rate from 3 to 6, and he doubles it. Most people would say, okay, you double that, then you would double that outcome. And so how Grayson ended with 40,000, Mark would say, well, that'd be 80. It's an easy answer. Logically and mathematically, that's what makes sense. Now, let's take it and kind of put it into the rule of 72. What Mark may think would be 80,000 is actually 160,000. Now, without jumping the gun and Jean seeing this, she would probably say, well, my 80,000 would have grown to 160 because she doubled it from 6 to 12%. Now, in that same amount of money, same amount of time, Jean's final kind of end result at 68 would be $2,560,000. So right now, looking at this, two things you may say, I may not have $10,000 or I may not be 20 years old. Well, the beautiful thing is no matter where you're at in life, business owner, non-business owner, for personal savings, business savings, is you have different kind of needs from your money. So you can look at it that way. As you can say, hey, I'm not 20 years old and I don't have $10,000. Or maybe you have 1,000, maybe you have 500, 200, 300. Being able to save and prep, and these kind of flow very similar with the 3 account system as well, to make sure that you're putting yourself in a better position down the road, keeping up with inflation and all of those good things. Now, kind of segueing from Rule of 72 to what I think is important for business owners. And me and Isaiah were talking recently just on, what makes businesses more successful. And debt can be a piece of it. But the theory of decreasing responsibility, I think, paints a really good picture. So with this, I always tell people that green arrow. So I'm going to try to pull up my whiteboard here and draw a little bit. As I tell people, this green arrow, this is your debt or your responsibilities on a monthly basis. So in our early years, or maybe early years of business, you have a lot of debt and you have a lot of responsibilities. Maybe kids are running around. And maybe you just bought a primary home or you bought your first business warehouse or whatever it may be. And so over time, we want those things to decrease. Now, at some seminars that I speak at, I always tell people, do most people over time stay in debt or have a huge focus on getting out of debt? Most of the time, they want to, or maybe they don't want to stay in debt, but through actions and decisions that they need to make, they end up staying in debt. Now, this blue arrow, this is your income, your revenue, and then your assets. So as we're decreasing that debt, we also want to, on the inverse side of things, we want our income, our revenue, profits, and our assets to go up to where at a certain point, these two arrows cross and we reach a position and a spot where financial independence is important, where profits for a business will increase because we're not having to pay those loans or notes off. And then this can equal retirement at some point as well. So covering those things, that really paints the picture, and it's a good transition and segue point to my next piece is life insurance. I think life insurance is one of the most misunderstood financial products. I think it's one of the most misused financial products because we don't always understand it. But majority of the time we say, okay, hey, we know we need it. And so looking at kind of the things that I think you should think about in the conversation of life insurance is I give this to you to understand, hey, do I even need it? Like with our home insurance, our car insurance, health insurance, we know, okay, yeah, we need that at that point. So I always ask people these questions is what type of life insurance do you need? How much coverage do I need to cover my liabilities and my responsibilities? Uh, do I even need life insurance? I think that's a conversation that we have with a lot of people because if we go back to that theory of decreasing responsibility, if our debt's at zero and we have, let's just say, $2 million at the end of the road, well, then you don't have any liabilities or responsibilities. Most of the time, kids are moved out of the house and those sort of things. Um, but to kind of clear the air on, okay, how do the different types work? What would you advise? It's definitely different per person, but I always go over the first piece. So it's going to be cash value life insurance. So you have your whole life, your universal life, your variable life. And there's some other ones nowadays that can also be different. But this, let's just say this is John and Mary at age 35 and they both have $100,000 in coverage. And it costs them $225 a month. But they say, hey, let's attach this investment into it to where, it can be more like owning your home and you'll have some value at the end of it. I think one thing when it comes to that cash value is the education that comes with it. We don't always fully understand, okay, how does that cash value portion work? And so looking at this, I always kind of go over to the side and I just say, okay, let's say that I knocked on your all's door and I'll just use Grayson in this example. And I knocked on Grayson's door and I said, Grayson, I'm going to give you 4 points and I want you to open an investment account with me. But at the end of those 4 points, I just want you to say yes or no. Would you open this account with me? Would you not open this account with me? And so I start and I say, well, Grayson, I want you to invest $225 a month with me. Now, for the first somewhere in the ballpark of the first 0 to 5 years, you're going to be putting in 225 a month. But at the end of, or somewhere in that threshold, if you say, hey, Daniel, how much is in my account? You're going to have $0 or close to zero for those first few years. It doesn't really grow any investment value across that period of time. Now, number two is, Grayson, we will guarantee you a growth rate of 2 to 4%. Now, on the back end, our company's going to return it somewhere between 10 to 12%, and our company's going to keep that difference. So very similar outcomes. Think back to the rule of 72 on that. Now, Grayson, at some point you may say, I need $50,000 a year, or not a year, excuse me, $50,000 to take out to pay for a new truck. Well, if you go and you take a borrow out of that, you're going to have to take that out as a loan. And typically that interest rate is about 5 to 8%. Now, lastly is, Grayson, if something were to happen to you, that cash value or that investment portion goes to our company rather than going to your family or your business. And so looking at this is understanding, okay, is this something that I need? Does it help protect me against liabilities to my business or maybe some unexpected things that could happen in the future? Now, that's one side of it. Now, on the other side, looking at the life insurance piece, and there's also key man policies, which can be important financially if you're the key man or woman in your business to protect you. But that typically follows on the term side of things. So let's say in this example, John and Mary take that same 225. And on the term side of things, maybe they get a 35-year level term policy. And it costs them $80 a month. Well, that saves them $145. And in that box you see right above it, maybe they went and grew it at 9%. Maybe they put it in a retirement or a Roth IRA and grew it over that period of time. Well, in that same kind of time frame and category that's on the left, John and Mary would have $265,000 in their Roth IRA. But looking from a business perspective, is one, now if it's in a Roth IRA, it has some restrictions, but maybe it's just in a brokerage account. That cash is liquid to you. You don't have to take it out as a loan. Something happens to you, your family receives that. So with a business, capital and having liquid assets available, you can also use this in a borrowing private line of credits at the bank, and different liens and different collateral loans that you can use on this. So it leaves your funds more liquid rather than tying them up and having a lot of restrictions. And so why I cover life insurance is as you grow a business, you take on a little bit more liability than say someone in a corporate career or on the W-2 side of things, because you don't necessarily have all of those benefits that some employers can provide. So now getting into the fun out of the education portion, I'm sure this next piece will still be education based as well, but getting into strategies just that I think are helpful. Now, that first bullet point, it's the answer everybody loves is it depends, because every business and industry is different. If a restaurant owner comes in and sits down, it's going to be completely different than somebody that owns a landscaping business or a contracting business or a auto body shop or something of that nature. Now, whenever it comes to taxes, this is one area that I think is crucial because you can fall behind very easily. But depending on what your background is in your prior career, can get overlooked in ways. And then when this time of year rolls around, you can be caught shuffling receipts, going back, looking at statements, trying to figure out what's going on. And so I do advise, finding a good tax advisor or a CPA, because in the establishment of your business, I think it's always good to figure out if you're in the correct entity for your industry. And that's a big kind of segue into that next point is legislation changes. So sole proprietorships, S Corp, LLC, C Corp, regulations and different people in office can change different small little details that can very quickly get overlooked that may be an opportunity for you to change. Also, whenever it comes to tax strategies, retirement contributions. That is 100% deductible off of your taxes every year. I think a lot of people in small business, just from my experience, they see, well, I can only open a 401k. 401ks are, I tell people, really, if you have over 25 employees, could potentially be a good idea. But they can be expensive to a small business. Versus, a simple IRA or SEP IRA is very low cost. It's very kind of easy to set up. But that's where, strategically planning with your advisor or CPA on figuring out how much you're going to pay yourself, figuring out if you want to put back for retirement. A lot of people in the early years of business, they don't necessarily pay themselves. But depending on how you're set up, it can be strategic to pay yourself in some ways. Now, another good tax strategy that keeps you one compliant but efficient as well is track your everyday business functions. So depending on what industry or field you're in, miles, expenses, dinners, equipment, parking, if you're driving and traveling around a lot. So keep those in mind because they can then funnel into your deductions at the end of the year. And there's several different apps, and I can always give you my recommendation on what I think works really well. Then be really on top of your deductions. Tax laws with the recent bill passed in Congress in 2025 changed a lot of things depending on your age, your business size, and two, if you're buying heavy equipment, you're not having to depreciate it over a period of time. You can accelerate that if it's the right kind of move. But I'll definitely tell you with office, home office, I'm not going to dive into the Augusta rule, vehicles and et cetera. Now, my one disclaimer at the bottom is this is not tax advice. Seek a tax advisor or a CPA. We're surrounded by taxes because it's a natural kind of parallel industry to ours. So I do understand it a lot, and I can just give you a piece of guidance to go talk to somebody to where you have some information and maybe bullet points when you go into speak with a CPA or tax advisor. So that's we got our taxes out of the way. April 15th is coming very quickly. We're 2 weeks out on that. Now, the next lovely piece is inflation. If anybody's went and filled up their gas tank or bought some milk or compared it, it's funny. A lot of people on social media will compare their Walmart receipts today rather than back during COVID. Inflation is always going to be a natural piece of our economy. I think it's really important for personal people in retirement. I tell our retirees all the time, we want to stay retired. We don't want to have to go back to work, but making sure that you're giving yourself pay raises. And so very relatable to that personal side is business costs today won't be the same in 5 years. And so if your business plan and your structure is solely based on dollar amounts today, we don't want you to have to go back to work in 5 years. We want you to stay in business. We want you to be a part of the survival rate in business. Calculate, prepare for current and future inflation. I think that's important when looking at your prices as well. Not only just expenses, but adjusting your prices of goods and services adequately, and keeping up with everybody else. And I think promoting that, and if you're kind of an everyday in your business, is when you're adjusting prices, let your customers know why. I think that's just from a consumption side of things. I think if I go and pay for a car wash and it's $20 versus $15, I'd like to know why the same thing's now $5 more expensive. Now, when looking at those 3 different accounts that we spoke about earlier, is making sure your future dollars are hedging, parentheses, beating inflation. So I gave you a little example down there as if we put $10,000 in a 3% CD at the bank, and 3-year average of inflation is 3.4%. Just on inflation, our money really went backwards 0.4%. So one risk that we learned very early on is just purchasing power risk. So that looks different for every industry. But the beautiful thing is the interest on that CD is also taxed. So I just put at a marginal bracket of 20%. Your real rate of return that you're actually getting is 2%. And so while that market and the things that we're paying for was moving forward at 3.4, our money was only moving at 2%. And so making sure in retirement and business that we're beating inflation, or at least keeping up with it, keeping up with the times. And that's something that we calculate a lot for a lot of people that are in that kind of stage of life and stage of business. Now, the next piece I think is a really good diagram and graphic on. I help people navigate this a lot, but your 401ks, your all of your different retirement account options. Now, these are the limits for 2026, but understanding who it's for, when should you put into what, I think is important. It's something that we weigh at the end of the year for a lot of business owners across the board, because some do have, calendar year deadlines rather than April 15 deadlines. But a lot of these ways can help hedge a lot of profits if you do really good one year. Now, for small business owners, I think ones that apply the most going to be that orange column that just says IRA, but your SEP IRA and that solo 401k. Solo 401ks are very misunderstood, or most people don't understand that they even exist. But it's like an own personal 401k for yourself. So for certain businesses, it can work really well because there is a borrowing capacity to it. So if we're kind of putting in a lump sum to avoid some taxes, or just systematically putting it in, and let's say you needed some capital in a few months or 2 years down the road, there is a borrowing component to that solo K. Now your SEP IRA is just kind of think of that as a traditional IRA for your business. So IRA just stands for individual retirement account. And being able to, obviously your contribution limit is way higher than your contribution limit on your IRA, your traditional and your Roth IRAs. I will quote, or not quote, but just let you know that Roth IRAs, you can phase out on income depending on how much you're making. But there's routes and strategies around that to where you can still seek benefit from that as well. Now, kind of getting out of the retirement account piece is, we all get into business and we all want to survive in business, like I was mentioning earlier, to make it to a certain point. So I always see small business owners is always from the start, the little things like wills, trusts, beneficiaries, succession and continuity plans, I think are important. Knock on wood, we never know when our last day can be. And so whether it's a family member taking over a business, or if it's a partnership that's established, depending on how you want to set it up, can be important. So I always have people that I'll give you some ideas and thoughts, but once again, I can get you in contact with the people that you need to get in contact with to establish some of those things. Trusts, for example, are very intricate, and there's multiple different types. And you start researching and looking, there's a lot of lingo that can be very confusing in that process. Continuity is very important. Us running our business. If something were to happen to me, there's a plan in place for all of our clients and our customers that we work with. And then that top piece is, I think, key to being successful is having a strategic business and financial plan. When it comes to your daily operations and your month ends and your quarterly goals and your yearly and semi-annually goals, hitting those, but knowing, I think it's a big confidence booster when you are a small business. Say, hey, we are growing, or man, Q1 was really tough. Why was it tough? Was it seasonal? Was it, people hadn't got their refunds yet? Were we kind of saving money for Christmas from the New Year's resolutions? What can kind of cause that? And so I think that legacy and legal piece can be very strategic as well. Now my last slide is, you can do it. Running a business and a small business is not the easiest thing. And so I'll have clients that just call and ask me that are in small businesses or just businesses for advice. like, hey, I'm thinking about buying this machine versus that machine. What would you do? Or, hey, how would you market this? Do you think this is a good idea? Um, I'm a very good just listener and kind of break it down and simplify things. And so the biggest thing is realizing you can do it, and having somebody like that in your corner, I think, is important. Now, the biggest thing when it comes to everything that I've shared with you all, I do want it to come from a truly educational standpoint, not a solicitation standpoint. So if you all have any questions, feel free to give me a call, shoot me an email. I do have some of our information up. You can scan that QR code and it'll actually take you to a scheduling link. But the biggest thing is for you all to call or shoot me an email or come by for a review. We do a lot of second opinions. It doesn't cost you all a thing. So if you want us to come in and piece together a plan for you, review any of your statements, documents, anything that you're thinking about, we'd be more than happy to do that. Now, on the cost side of things, if we're managing accounts and money, that's when we're compensated. But a lot of those preliminary steps, you may come in and investing and opening accounts may not be on the forefront. Maybe it's, hey, let's look at our cash flow for 3 months. Let's see where we're at after that. And then let's formulate a plan after we have some kind of track record and details and things of that nature. But other than that, I just want to say thank you to Mark and Gene for giving us the opportunity to do this. I'm very passionate about this. So if you have a question, call me now. If you don't get me, leave me a voicemail. Everybody gets calls from scam calls all the time. So just leave me a voicemail with some information about you, and I'll make sure to get back to you. You can also call our office line and reach Landry as well. But just want to say thank you to Mark once again, and for everybody listening to us, go for that. Does anybody have any questions, thoughts, anything of that nature?
Questions?
You are welcome, Scott. I just saw your message, and you too, Courtney. We miss seeing you over here. We're gonna have to come over there and see you.
All right. Any other questions? Well, thank you all for joining us today. And thank you, Daniel. As promised, he said it would be simple, so even folks like me, simple country lawyer like me, could understand it. So that's a good thing. But as a former D1 offensive lineman, he clearly showed he knows about a good offense financially, right? So there you go. So, and I know Daniel works hard and his team to meet folks where they are financially, and we appreciate his guidance. You can watch this program as well as our past programs on our Noon Knowledge YouTube channel. So we encourage you to do that. And we hope you'll join us for our next Noon Knowledge. Those are generally on the first Wednesday of the month. So next month, Wednesday, May 6th at noon, when Isaiah Thomas will be speaking to us, our economic development specialist with the town of Abingdon. And he's going to talk about tips for dealing with local governance. So if you're in business or starting a business and you're thinking about expanding, thinking about locating an office, you need to know where to start. You need to know, do you need a permit? Do you need a business license? Do you need the health department inspection? How do you deal with building officials, things of that nature? How do you collect and remit taxes for like meals taxes and things? That varies by location, but he's going to talk about some general strategies on things you ought to be considering if you're looking to build or expand your office. So I hope you can join us next time with Isaiah Thomas. You can register in advance for that, and you'll be seeing a link about that soon. And if you have, as always, ideas for future programs, certainly contact us and let us know, and we'll try to make sure that we put those out there for you to utilize. So thanks again for joining us today. Thank you, Daniel and team, and I hope everybody has a good rest of the day.